tough act to follow on all that gold, with gold at about all-time highs and real estate struggling. I'm Ross Weiner, president of Gemsco Capital. Basically, we're a private real estate investment and advisory platform focused on commercial real estate. We invest on behalf of ourselves, some family offices, high net worth, and other funds and partners. We basically seek equity, debt, and securities investments across all different categories, wherever we see opportunities. That's what I do. But the discussion today is really going to be more about our panel. Our topic is alternative real estate. I'll make a brief introduction. It's a little bit challenging having everybody remote, but we'll do our best. And I understand people are spread all over the country. We have Zach Ships with us. Zach is a principal with Northbow Partners. It's based in Atlanta, an opportunistic real estate private equity firm with backed by a family office, significant committed capital and meaningful operational experience. Like I said, based in Atlanta, and they're doing some interesting stuff. Liz Habib is with MPI Family Office. I don't know Liz, so nice to meet you the first time. Liz has really quite an impressive background. She's a journalist, broadcaster, real estate investor, sports anchor, professor, business owner. Did I miss anything?
No, you're doing great. You'll get to know me.
That's great. I look forward to it. MPI is a family office, single family office based in St. Petersburg, Florida, and offices in Pittsburgh. So I'd love to hear what MPI is doing and what Liz is doing. And Nipun, I hope I get your name right. So help me on Nipun Dubey.
Yep, you got it.
Okay, great. HappiNest.AI. It's what I understand, that's a new venture for you. And it's AI-powered real estate solutions to boost sales and slash costs and maximize NOI. So I'd like to hear all about it. Let me just give a brief, just sort of real estate market overview. Real estate continues to struggle overall as an investment class. I like to use the public markets as a gauge, and one of the real estate ETFs is called XLRE. And if you pull up a chart of that, you'll see it's gone pretty much absolutely nowhere all year long. And it was down about 1.5% today, while the market is at pretty much at all-time highs. Gold is pretty much at all-time highs. So there are other investment classes that are doing well. And real estate is just a story, in my view, of a couple things. The economy, inflation, interest rates, unemployment. And if you look at, we've done these panels before. Interest rates have been stuck in a band, the 2-year between, say, 4.5% and 5%. The 10-year at about 4.2% to 4.65%. And inflation has been, persistently strong. Even though it's come down a bit, it's still in the threes. And frankly, I and a lot of other economists expect that it's actually going to go up into year end, not down. So I wouldn't be surprised to see 4% prints as we go forward from here. And unemployment's been ticking up. So it's been a tough environment for real estate. We know the problems with loans coming due and banks lending, and the problems with New York City office space and office space around the country. So still a lot of headwinds. A lot of people sitting on the sidelines, but I think our panel is still active in some classes. So let's hear from them. Zach, why don't we start with you and tell us what Northbow is doing and what are some of the alternative areas that you're focused on?
Yeah, you got it, Ross. Thank you for the intro. So we're a real estate focused firm based in Atlanta, as Ross alluded to. And we are off balance sheet of a couple family offices. So we take family office capital typically and source and structure kind of niche real estate investments, mainly in the Southeast and Mid-Atlantic. The past 5 years, we've been pretty heavily involved in industrial and outside storage, retail, grocery anchored retail, and self-storage to name kind of our focus. And today, as Ross alluded to, real estate's not a very sexy investment to have on the broad markets, if you will. But where we've been able to find some alpha for us is in triple net lease development and acquisition. And then also we like to play deeper in the capital stack. So private credit's been a very often used buzzword, as you all have heard, I'm sure, not just today, but in other investment opportunities you look at. We agree, but we play in that in the real estate space primarily as in a mezzanine debt or preferred equity provider. And a lot of that's been in multifamily, whereas 3 years ago, you had multifamily construction loans made, and you have Class A product being delivered that's over budget, behind schedule. And instead of taking construction risk, we're making pref equity investments and taking lease up risk and getting a net mid-teens to low 20s. And then we're also doing the same thing in triple net lease, which is investing in Chick-fil-A, Dunkin' Donuts, Starbucks, Valvoline Oil Change, Wawa, 7-Eleven. We've built about 180 of those in the past 3 years. And the dislocation in the capital markets right now has made that a very attractive investment as well, where you're able to build to a bigger spread and drive a better yield. And we're looking at the same general returns on that net of around high teens to low 20s. And so in the broader real estate scheme right now, triple net and structured finance is really where Northbow has been seeing opportunities.
So did you say you're getting high teens to low 20s on triple net?
That's correct. Yes.
How do you manage that?
So great ask. Our network is primarily Southeast and Mid-Atlantic, and so we find best-in-class developers who are typically a preferred developer status with the tenant, whether that's McDonald's or Dunkin', who will come in to their office and show them where they need to go. And so our development partners and ourselves are spending less time finding sites and then hoping we can backfill it with the tenant. And our time focuses on basically fulfilling the tenant needs and the site selection that these teams have. And these Class A tenants, they're going to have a better site selection team and data than anything that we could buy on the street. They know their tenants better than anybody else, and they give us direction on where to go. And part of that is due to tenants are continuing to expand. Menu board pricing continues to increase across the board. If you look at Dunkin' Donuts, for instance, from 2003 to 2020, their menu board pricing increased 3 times. In the past 4 years, it's increased 3 times alone. So part of that's inflationary. They're feeling the pressure, passing it on to the consumer. They know where their consumers are, where they want to go. And what they need now more than ever is a development partner who's well capitalized and can execute. And so when we partner up with somebody, we vet them, we prove them on our own balance sheet. And then once a project's de-risked, meaning land's been sourced, pre-dev's been funded, we've gone through the entitlement risk, we're signing a GMP contract to build the building, or in the case these days, most of what we're doing is a ground lease scenario. So 2/3 of our development deals are ground leases, where we own the dirt, fee simple, and then lease it back to the tenant who then builds their building as well. So we're doing this all with at least 150, if not 200 plus basis points in spread over current in-place cap rates today. And so when you're building in A location markets with top tier credit tenants, you're basically developing a bond that you know the market will take at a 5.5 or 6% cap rate today that we're able to deliver for 7, 7.5, 8 plus. And that's how we're able to drive those yields, even with debt coming in at 60% of the stack and equity taking up the other 40.
Sounds like a nice business. And the private credit side of your business, what does that return?
So we're typically call it mid-teens to upper teens. And that's primarily family office focused right now on the pref equity front, where we're really conscious about where we're coming in at last dollar on the stack. And typically our last dollar is going to be between 60 and 75%, which means you have anywhere from 25 to 40% equity ahead of you. And our last dollar price per unit on new Class A apartments in the Southeast is typically right around 200,000 a door, which most groups have built this product to upper 200s a door, if not over 300,000 a unit. And where a lot of those budgets were blown because of inflationary issues, logistics issues with construction materials and pricing and equipment over the past 4 years, we're able to take advantage of that now. And we're not a large firm coming in that's going to broadcast issues that you've had as a developer, especially a Class A developer in great core markets in the Southeast. Think Tampa to Jacksonville, Nashville, Raleigh, Charlotte, Atlanta are markets that we like, and playing in kind of the first ring outside of those markets in some of these bedroom communities where you still have strong job growth, rent have stabilized, if they've slipped a little bit, there's literally no new supply coming on the market in the next 3 years. You have strong macro housing tailwinds for growth, where it's becoming cheaper to rent an apartment than it is to own a house with where rates are today. And so taking all those metrics into account, we're really bullish where multifamily is long-term. Now, I'm not bullish on being an LP and having a last dollar at $285 or $300,000 a unit today, but we really like playing in a space at 185 to 200, maybe even just over 200, depending on where it is, and driving a mid to upper teens net return over the next 3 years.
You're basically getting equity type returns for debt type risk for shorter period of time. These are short-term financing instruments, like 1 to 2 years.
Yes, you nailed it, Ross. That's part of what we like to do, is extrapolate where we can drive good yield. It's for taking the least amount of risk possible. And so most of the preferred equity investments are in the 3-year range. And then our net lease projects, we're developing and selling those on a merchant build basis. So you're anywhere from 12 to 24 months with a typical turn time of 15 to 18 months. And we like to cycle that capital and tend to think in terms of multiple as well. But yeah, we like short duration. Go ahead.
Like I mentioned earlier, this is a fun format with everybody remote. Liz and Nipun, you can feel free to jump in and ask, questions about anybody else's, model. So you can ask Zach any questions if you have. And Zach, you focus on the Southeast primarily because that's where in the case of the triple net, where the tenants want, or you like the states because of the growth dynamics or lack of state real estate income taxes and lower taxes. I mean, that's what I hear from a lot of investors. Everybody's like Southeast, Southeast, Southeast.
Yeah, all the above, Ross. I would say you've got very business-friendly states, and if you look at where a lot of investment is pouring into real estate, it's predominantly Southeast, and then you also have just a lot of tenant growth here. And so real estate's a very localized investment vehicle, and for us to partner with developers, we want to partner with the best-in-class sponsor who runs kind of from Fort Myers to Tampa, and then Southeast Florida is its own different animal in the Miami market. And so we are seeking out and vetting the best-in-class, developers, and a lot of that's through tenant relationships. If you go to our website, which is northbow.com, it's a one-page landing page. We don't want anybody to know who we are. We don't want to answer a bunch of calls looking for capital. We literally, our job is to cherry pick and find and leverage our experience over the past 20 years and partnerships to really drive value and find the right groups that are looking for a true partner, not just a lender to put money in a project. So we roll up our sleeves. We're involved early in pre-dev. We understand survey to leases, entitlement to MPs with contractors, and what components of a development process can bite you. And so our team here at Northbow, we're lean. There's 8 of us. And so we really lean on the right partnerships, the right third-party consultants, and then our track record and experience to really drive yield on these and find the right opportunities. So it's hard to just go. It's hard to go online or go somewhere and just find a Chick-fil-A that you can put, $600,000 in and 1.5x over the next 18 months. But if you have the right partners and they're working with the right tenants, geographies, we've been able to do that pretty successfully, thanks to a great.
Yeah,
and
great.
partners.
I happen to be a big proponent of Chick-fil-A's in general. Love going to Chick-fil-A. But and
I'm
I
pretty
tell
sure
people if they ever go public, I'm going to try and get in on that IPO in a big way. Liz, why don't we go on to you? And sorry to make everybody wait. Like I said, I apologize for the format today, but we'll do the best we can with it.
Who'd ever
Michelle's, what's
thought
going
we'd be
on?
all over the country, right?
Yeah, exactly.
A lot of what Zach just said is what MPI Family Office is all about. I'm hoping you guys can hear me okay, because I've got to listen to you off a different Zoom. So I've got two different things going on and I hear reverb in my ears. So I'm going to work with it. Anyway,
Okay.
let me
We
tell you a
hear
little
you.
bit about who we are. We are our MPI family office. So it's my family office. We're a single family office based out of St. Petersburg, Florida. Two of my brothers are the founders of MPI Family Office, Dr. James Powers and Peter Habib. Peter's the CEO of the family office. Dr. Powers, my brother, is a vitreoretinal surgeon. We have healthcare facilities in Florida. Zach, we're very involved in Florida, right? With everything, Chick-fil-A's and everything in that area. Diabetic retina specialist healthcare centers in Florida is how my brothers built their wealth. I came along and now I work with our family in our family office. Now, as a member of the family office, we invest in real estate. We own about 7,000 units, multifamily, storage, senior housing, and something that we're very bullish on right now that I want to tell you about, which is hotel conversion to workforce housing across the United States. We've been doing this, building the family office for 20 some years. So we are heavily invested, but we have a highly specialized formula. We have an investment strategy, you could put it, and it is in multifamily. And it is because a lot of the reasons that Zach just mentioned, right? So we're in sort of the typical states, but all over the country, not in the coasts. I happen to be in California right now because I work out here in California building our connections with other family offices. We do a lot of networking with other family offices. We invest alongside other family offices. So we have a consortium of wealth and health because we're in the healthcare industry, and wealth because it's our family office. Our mission is to preserve and grow the family wealth. So I'm out here in LA today, and one of our opportunities, I've heard different people, just like Zach said, we're not sexy. This isn't sexy like gold or like Marco Soriano. I just love listening to him, right? With that Italian accent. He's talking about EVs and he's out of Italy with the luxury race cars. And it makes me want to stop everything we're doing and invest in him because of how exciting all of that sounds. We are in a very conservative investment in multifamily. And we're really happy with our strategies. We've done very well with them over the last 20 or more years doing this type of work. Right now, and I've heard a few different people on different panels say that family offices are overextended, that family offices are holding on to dry powder, that family offices are skittish about investment. I'll tell you, that's probably true with all of the family offices we work with. However, we are actively investing. Right now, we've got a tranche of about 5 to 10 properties that we're taking over in this hotel to workforce housing area on these assets that we think work for a number of the reasons, for instance, that Marco likes investing in what he's doing. Number one, population growth. Where the population is where housing needs to be. And if you want to call it ESG, I'll call it ESG, maybe not by government standards, but we're solving the affordable housing crisis in the United States by taking buildings, properties. We have 2 in Baltimore, for example, 500 units. Former Radisson Hotel, a former Hilton Hotel. In fact, they had the 1980 Republican Convention in one of these hotels in the Inner Harbor area in Boston. And we're converting those to what we consider affordable housing. Now, not by government standard affordable housing because the government's not involved. These are specialty areas. I see my camera went out, but I can keep talking to you. Specialty areas where it's not government housing involved in some of this, or not government funding involved in some of this. So we've got some properties. I'll give you a little backstory here, and then you can ask me any questions you want about it. We've got some properties. We were teamed up with a company that has come into some financial problems. They have about 50 of these properties. We were initially invested over the last 3 years in about 8 or 9 of these properties. They're in a situation where they need to liquidate. So we're in a situation where we are going to go in and we're going to buy these properties, right? We've got one in Kissimmee, Florida. I'll just give you some details on it. We're going to pick it up for about $21.5 million. This is a former hotel. These are hotels that went through some distress during COVID. Our basis is $25 million. We're going to relook at those, re-underwrite it. We're refinancing it. We're freshening up some of the debt. We're reinvesting in it. And we're making a strategic decision to open this up to other family offices for investment. Now, usually our deals are we have relationships. So we have relationship deals where this is how we invest in other family offices deals. They invest in our deals. We invest alongside each other. But because we've got this tranche and this opportunity coming up for these properties, we're opening up for other family offices. And it's not big investment. We're looking anywhere between $500K to $2 million. If family offices are interested in learning how we do investment, the types of properties we invest in and what we do. A little bit more about these properties. Others have talked about this. Zach, you just talked about this. In Kissimmee, Florida, great location. Universal Studios is building 5 new theme parks. There is, in this Kissimmee area, there's an Amazon. There's other great businesses. We have the place 90% occupied. They're about 350 square feet each. So they're small units, but they look great. We rent them out for about $1,025 a month. And when you look through the rent rolls, we've got things like college grads, recent college grads, people who work at the Amazon nearby. We've got chefs, say a chef who works at a restaurant nearby. People who need to get in at this lower rental price because they're priced out of the market with everything that's gone on in multi-housing over the last 3-4 years. The rents are just too high for them. So they need to get in at a better price point. We went in, we converted the hotels at $96,000 per door. And now we see the opportunity in the next 6 to 12 months to take these properties over to agency debt, to refinance, to take our money out and to hold on to them and have them cash flow for years to come.
Now, I've seen this before in very limited examples but if you can get the right kind of property and location, typically you get something that changed for a good reason. Like in one case, I saw a deal where this kind of conversion was done on a Marriott hotel that was in an office park, but in an area that needed the same kind of housing. And what they did was they renovated and really fully amenitized the property. So it had, outdoor pool and a big fitness center, and they built a pickleball center and a whole bunch of amenities that we normally would not find in any other apartment complexes. So it's an unusual kind of structure, but it can work, depending on the execution of, how you redevelop it.
Can I ask a couple of questions?
Sure.
Hi. So are these micro apartments?
Yes.
350 square feet, 300 to 350 square feet. So I guess you could call them, right? They look great. What we consider our sort of special
what's the
sauce.
kind of pricing in Kissimmee? So, I mean, Maxwell Drever was doing this in Mississippi where they have all the casinos 5 years ago, 6 years ago, doing a lot of conversions of hotels because they had a lot of workforce for these, it's highly seasonal, right? The whole casino business, right? So, and he was backed by a religious organization, by Catholic Charities. So they were actually paying the first year's rent for the people who are working at casinos. Because they're expensive places in Mississippi on the riverboat, right? So I mean,
I'd be curious what the
pays the
price
rent?
point is and how that did, because it's a genius strategy. And I'm going to tell you why. I don't know how many years ago he did that, right? But getting our price point, like in Kissimmee, our price point for rental, if you're asking the rental price, $1,025. We have a property in Omaha, another great market, terrific submarket area where it is. There's a Topgolf across the street. We're around $350 a unit. We've got some corporate units in there. That one, the rents are going for just about $740 a month for rent. Now, it still is a nascent business, right? So while some of this has been around for a while, not a long, long time. So the challenges, one of the challenges we run into, and I'll hit it face on, and this is why I kind of like what I heard down there going on, is the initial lease up. We have our properties leased up to 90%, and we think these are home runs. And that's why we're investing again. We're just so excited about where they are. But getting people in, you need a very you need good marketing. You need a good property management team that understands how to lease up properties like this, because they're small and sometimes the renters may not understand, why wouldn't they go down the street for that studio apartment down there? So they filled it, in that case, what you're saying, by offering a concession, a free year of rent. Amazing. And did they fill it and keep it full and keep that occupancy? Because part of the challenge has been, of course, filling these. And sometimes that initial lease up was what slowed this down and caused some of the financial trouble in some of these.
Do you have full kitchens in those 350 square foot units?
Say it again.
Do you have full kitchens in those units?
They have full kitchens. And I should describe the properties a little better, because you were right on, Ross, with what you said. We've created communities here, right? So we've taken the ballrooms and we've made workout rooms. We have the swimming pools. Sometimes we have telemedicine facilities on the property. Healthier people, better living, rents get paid more often and on time. So think about a Radisson long stay where they have like a little bit of a kitchenette. The kitchenette's been upgraded with granite countertops, and maybe it's got a smaller Ford cooktop, that type of thing, but really nice looking appliances, surprisingly great looking properties, because we really believe our construction team is great and does a good job.
What kind of returns are you trying to get on those kind of deals?
Right now, we're looking at IRR anywhere between 17 and 26% IRR to 2.5x over 3 to 5 years.
Is that with any particular kind of leverage?
Not really. Each deal is different.
Okay, great. Well, it sounds interesting. Nipun made you wait, so apologize for that. Why don't you jump in and give us an overview of what you're up to?
Can we ask more questions on this strategy on the micro apartments?
Okay.
We have more questions. So I just want to ask,
sorry.
I want to ask one more question before Steve starts.
Steve, I know you
So
always have.
with respect to the micro apartments, is the rent paid by the renters or by the people that have a lease, or are there services that are paying the rent?
Oh, no, that's paid by the renters. These are regular renters. Maybe it's a student who just left college and has only been out for a year. So they're renting and paying their rent just like any other renter would do.
And I
There's just a need for this type of
It's an
housing.
aside, Ross. I know that office buildings are not 95% in New York are not convertible to apartments, but can they be converted to hotel rooms? Do hotel rooms need windows?
Yes.
Yeah, hotel rooms.
You need bathroom and toilet.
Do you want to stay in a
Yeah,
hotel room
light.
without windows?
I'm just asking.
I mean, yeah, for the most part, you need
Air and
windows.
light. There's a requirement for air and light
Yeah.
to cruise ships.
Yeah, I mean, I think you'll be more likely to see over time, Marty, that some of these buildings get torn down, provided that the zoning gets, changed. Right now, some of the buildings, they're zoned, for example, for more FAR for office buildings than they could be used for residential. And if the governmental entities can square that and make the zoning better so that you can get the same FAR for your buildings, it'll probably make a lot more sense to just buy an old building, knock it down, and build something new.
Exactly.
We're not there
I
yet.
mean, I'm just saying that the micro apartment hotel conversion to apartment is very intriguing because of the situation United States is in terms of housing, and especially workforce housing, as Liz brought up. So Steve, let me default to Steve.
I'm just curious, the 300 square feet is a fairly small apartment. If it has a kitchen in it, obviously must have a bathroom. Is the rest of the room like a studio? So you have a sleeping area and then like a living or dining or whatever you call it, some other area? And is it?
I think it's Steve, right? It depends. We have 1 bedroom and we have studio. So if you envision a studio with the bed and a little sofa and the kitchenette, you have a pretty good idea of what it looks like. Plenty of living space. And what we see with younger people, we do have some elderly people, some people on fixed income in some of these buildings. But what we see with younger people, is that's the way they're used to living if they were in college. You know, the communal space is what's big to them. Do they walk out the door and is there a game room with a pool table? Do they get to hang out and watch a game together with someone? What does the workout room look like? So those are the things they're more interested in going in, and they're comfortable in that smaller space. In the buildings I talked about in Baltimore, which, and let me address this because you talked a little bit about zoning. We have, at this point in these buildings that we're able to bring into this tranche, we really have de-risked these properties. We've picked them up at a low basis. They're in the right location with the right demographic. We've taken care of all that change of use. Baltimore, we needed some help with some of the water issues in Baltimore, and the city came in and helped us. So we really are going to have two properties there, two buildings there that the city of Baltimore is really going to be proud of in the end, because they're helping us solve their workforce housing there as well. So it's really exciting for them. But we do have to overcome zoning issues in some cities and towns, and it has slowed down the process in some ways, but that's all been taken care of over the last 3 years. And now these properties are in the final stretch.
Yeah, this is like a New York City apartment.
Are most of these towns relatively in depressed areas? I mean, like Baltimore?
No, not at all. We've got Omaha, Nebraska. We've got Kissimmee, Florida. We've got Greenville, South Carolina, which is a fantastic property, completely leased up and ready to go. Let me think if I can name some other. Wilmington, North Carolina. So really in some nice
Southeast, got it.
areas.
Yep, got it.
Okay.
Baltimore's
we'll have
just
some
the
more time
biggest
for
we have.
questions as we go forward. Why don't we let Nipun get into the conversation?
And we have about 10 minutes.
Yeah, hey everyone. So we've had some really riveting conversations today. So Liz, Hogan, Zach, HappiNest.AI is actually based in St. Petersburg, Florida, in the Tampa Bay area. So we're in your neck of the woods. So my name is Nipun Dubey, CEO and co-founder of HappiNest.AI. We're the leading AI-powered PMC solutions company in America for the middle market segment. So that's defined anywhere from 500 doors to maybe 5,000, 6,000 doors. We provide AI-driven services in marketing, leasing, and tenant management. So Liz, you were talking about, no matter how good the deal is or no matter how good the structure is, how creative it is, at the end of the day, the success rests upon how you market it and how you lease it out. And that's what we found as well. And so our all-in-one approach really addresses industry fragmentation, high manual labor costs, and this results in a lot greater revenue for owners and operators for your properties. It reduces OpEx, which at the end of the day maximizes your NOI, and that's our goal. At HappiNest.AI, I think what we do is pretty unique. We have something called the PAD. You guys have never heard of this, I'm sure, because it's groundbreaking tech. It's called Private Asset Database, and this approach sets us apart by integrating owner, tenant, public, and PMS private data to create a comprehensive AI ecosystem. And so in today's real estate environment, we know with the interest rates, with inflation, it's more important now than ever to really have operational efficiency to increase and maximize your NOI. And so our PAD infrastructure comes in at the infrastructure layer for real estate tech, which allows you to build customized, tailored AI agents to help you for leasing, for marketing, for tenant services. And so it really, helps across the entire funnel, right? From owners and property managers to even your tenants who are happier now, and increases that operational efficiency and boost NOI. I'm going to give you an idea of how this kind of came to be, because this was born out of sheer necessity. So one of our co-founders and one of our advisors, he's a multifamily investor, runs a small family office as well, probably done about 70 million in GP deals, and then maybe a few thousand units passively. And so what we found and what he found is that, how a property is managed can make or break it. You go through one property manager, maybe it's not working out. You go through a second one, but you get to the third one. By that time, your property is dead and the deal is dead. And so what we started doing is we started employing, some AI technology. We started building it out, and that was version 1.0. We had hired one of the largest property management companies in St. Pete, and in 6 weeks, they weren't able to close any leases. But then we started implementing these tools. We started integrating our AI marketing services, our AI leasing services. And in the span of a few months, and this is real data from February, March, April, we were able to close 42 leases in a 50-unit property. And so when we went back to the property management company, they were floored and they actually became one of our first customers. So to give you an idea where we're at today, so it's a new company. We're a
I'm sorry, what was the cost of that? Of your closing those 42 leases versus a human?
Yeah. So the way we did is we did a commission structure. So we took a 10% commission on the lease. And then in terms of the actual technology, we were charging all in maybe $1 or $2 per door for the bots and for the AI tech. So it was pretty affordable. And right now that was one of our first, test cases. I'll give you some updates on where we're at right now. So
Can I
it's
just can I interrupt it one more time? So was that San Eng's company?
yes. So that
So
was
San is another Wharton guy who we know for many years, who's spoken on these panels, probably for 10 years. So
yeah.
We had them on the panel.
That's it. I'll give you an idea of the HappiNest.AI team, and then I'll talk done in less than a year. So myself, I'm also a Wharton alum. I've led AI startups, B2B companies, raised money, exited, worked at bigger tech companies like LinkedIn, Microsoft, and really found my sweet spot with real estate and startups. And this being my most exciting venture right now. Our team has over 90 years of experience in the industry, has raised several nine figures in capital and deployed it. So we really have a rock star team. And so with that rockstar team, in less than a year, with zero external funding, we've gone to 6 figures in ARR with our customers, about, I would say 10 to 13 customers right now. We have over 100,000 doors on the wait list that we're onboarding to service. We've had some early onboarding successes with a company based in Southern California with about $1 billion AUM. And so they have a few thousand units that we're going to be deploying with. And then we also have St. Petersburg's largest PMC as one of our customers. And so we have real potential for, lined up for a 7-8 figure ARR next year and the year after.
Does a customer access this through an app? Is that
Yeah.
how it works?
Yep. So right now we're doing custom implementations for our early customers, but what will be going live this summer is our unified platform. So you can go to HappiNest.AI, our website's up, and then you'll be able to log into the platform. And in one really clean, unified dashboard, you can manage all your marketing, you can manage your leasing, you can see your conversions, you can see all the conversations happening, you can even see maintenance requests, tenant services, how many leads are being qualified. And so the way HappiNest.AI works, I'll kind of dive deeper into it, right? So we have 3 core buckets of, excelling at property management and automating it. We have the marketing side, which is top of the funnel, right? So that's increasing your revenues, increasing your sales. And to achieve that, we use AI to do daily posts across all your social media platforms at a fraction of the cost of a traditional ad agency. We automate the content development, the distribution. We do it in multiple languages, so we can target people in China, and, people that speak Spanish, Arabic, English, you name it, multiple languages, and it captures all the leads from all your different ILSs. So that's your Zillows, your Trillia, all those systems get captured into one clean dashboard where you can see it all filtered in and organized. And then our AI leasing bot qualifies those leads coming in. And that's really powerful because what we're doing is we're actually integrating and centralizing your leads from a variety of platforms and sources into one place. And then our AI bot, which doesn't sleep, it doesn't take Sundays off, it doesn't, take bathroom breaks or food breaks. It's working 24/7 for you to qualify those leads and then filter it out so you have the right potential tenants match with the right apartments and right buildings you have. And then from there, it facilitates a virtual tour or maybe an in-person tour with the customer's on-site team. And then virtual tours are something we provide as well. And then once that's done and you're able to close that lease on the back end, we offer some tenant service as well. And that could be something as simple as wishing them happy birthday and keeping your tenants happy, to actually fielding maintenance requests and process them, in a few minutes versus a few days. And then also providing rent collection services on the owner side and other tenant services. So that's kind of the full suite that we're providing for property management.
is this a software as a service license, or are you paid on some kind of commission? How does it work?
Yeah, so that's a great question. So our primary model is we're a per door subscription. So it's going to be for depending on your the deal we have with you, and depending on the size of your properties and your buildings, it would be, let's say, I don't know, a few dollars per door per month to get the full gamut of our services and our AI technology. And then for AI leasing, we're exploring, depending on the level of involvement we have, like whether we're doing virtual tours for you or not, we would get a percentage of that lease as a commission.
So when we talked about this, you said that there's an opportunity to do a lot more strategic pricing on your rentals because the AI has the ability to kind of plan things out into the future. What do you want to drill
absolutely.
down on that?
Yeah, so we actually support dynamic pricing. So as part of our PAD, right, our technology, our infrastructure technology, our private asset database, what it does is it creates a custom AI brain for your building and for your area. So it knows the demographics, it knows the your competitors' pricing, it knows how things are dynamically changing, and then it can price that in there strategically to maximize your leads coming in and to maximize your leases being closed. For example, right? Let's say you have a property in Tampa that's close to the beach, and maybe it's near a university, you got a lot of young folks. It knows that the term is ending, a new school year starting. It knows how to do discounts. It knows how to do those promotions using AI, and also because our PAD processes all the data nearby. So your tenant history, your owner history, your public-private data, your PMS data, your demographics, your location, and so on. So it can create that customized pricing real time for your property in Tampa. Now, let's say you have a property in Chicago where it snows maybe 3, 4, 5 months of the year. A lot of professionals in downtown Chicago. It's a different demographic, right? You might, do a St. Patty's Day promotion in Chicago because they dyed the river green. And that's something which can be effective for professionals at a particular time of the year. So our AI can know that, digest it, process it real time. And as an owner and as an operator, we make it super easy. You just go into one place, you log on, you have all the stuff connected, and you get to see your reports, you get to see what's happening, you get to see where things are working, where they're not working, and what the recommendations should be to make it even better. And so that's what we're providing. And we found it to drive quite a bit of value for some of our early customers. We got the bigger customers locked on, and then we have our wait list, which is growing quite fast. Right now, it's over 100,000 doors. Sorry, what was that question?
That's great.
Yeah,
It sounds interesting if it works.
definitely.
I mean, it's the, sort of the direction things are heading in is how you can use these
Nipun, are
tools
you
to
raising
improve.
money?
Yeah, so we did open our seed round, and so that is open right now. So that's we have capital committed for our and so we're looking at some strategic partnerships. We're looking at finding the right partners for our funding round. And so that is open right now, yes. But to give you context, right? To give you context, with no external funding to date, we have achieved 6-figure ARR and 100,000 doors lined up. So with the funds that we'll be raising, that's going to help us service our existing wait list of 100,000 doors, which will give us a 7-8-figure ARR in the next year or so.
How much are you looking to raise?
So we're looking to do a friends and family round of a few million, and then a bigger institutional round of maybe 5 to 10 million, and maybe Q3, Q4 of this year.
Okay, why don't we switch gears a little bit and just use our time for any questions people have for our panelists or real estate in general? Financing markets? Nothing? Everybody's tired and hungry?
Everybody wants to go to dinner. Can you blame them? I wish I was there to go with
I can
y'all.
tell. I can't blame them.
Yeah, Liz, we miss you.
I miss you guys.
Well, look, this was very interesting, and in particular with Liz and Zach and the properties that they're buying is a good example of what, alternative real estate means, is that these are, sort of outside a little bit traditional areas. Triple net leases are very popular with 1031 investors, but they're, not what everybody thinks of when they think of real estate deals. Same thing goes for mezzanine and preferred equity structures, and, kind of the adaptive reuse of properties like hotels into apartments can be very creative solution, and solve a couple problems. One is, a property that did not succeed being the hotel, and the other is the need for affordable housing, because we still have a affordable housing crisis in the US. And to the extent that we can develop AI tools that'll help us do that better, more efficiently, and add more to the bottom line, that's a great thing. So thank you to our panel. Appreciate you all participating today. And I guess we're done here.
Thank you.
Great job, guys. Thanks so much.
Thanks.
Thanks.
Thanks, guys.